You open your trading app one morning, coffee in hand, small smile on your face. You're feeling pretty good. The market's been kind. Your retirement fund finally looks healthy. You scroll through the numbers, all green yesterday. Maybe it's time to finally book a vacation. Then you refresh the screen, and suddenly it's a sea of red. Your portfolio's down 15%, maybe 18%. You open CNBC, Bloomberg, every headline screams, market crash. You scroll through social media and all you see are panic posts. Your group chat lights up. Should I sell before it gets worse? And that calm, rational investor you thought you were 3 days ago? He disappears. Now you're sweating, pacing, looking at that sell button like it might save your life. Here's the thing. That panic you feel right there is not just you. It's human nature. Every investor tells themselves they'll stay logical when the market turns, until it actually turns. Then instinct kicks in, and logic goes straight out the window. If you want more psychology-based insights on money, investing, and wealth building, make sure to subscribe. Now look, this isn't a video about how to predict the next market crash. Nobody can do that. Not me, not the gurus, not the talking heads on TV. This is about something deeper. Why most investors panic when the market crashes, and how to make sure you never become one of them. Here's what most people don't realize. The stock market isn't really about numbers, profits, or charts. It's a mirror for human emotion. It's fear, greed, and hope turned into price action. Every rally is optimism. Every crash is anxiety. Every bubble is greed. Every sell-off is fear. And what makes people lose money usually isn't bad information. It's emotional decision-making. Because when markets crash, your brain doesn't see percentages on a screen. It sees danger, literal danger. Your amygdala, the fear center of your brain, reacts the same way it would if you were being chased by a predator thousands of years ago. Cortisol floods your system. Your heart rate spikes. Your palms sweat. Your body enters survival mode. So when people say, "I just want to play it safe," what they often mean is, "My biology is screaming at me to escape discomfort." But here's the problem. The stock market doesn't reward survival instincts. It rewards emotional discipline. This is where it gets interesting. According to research from Dalbar, the average investor underperforms the very funds they invest in by several percentage points annually. Think about how insane that is. The investments themselves perform reasonably well, but the people investing in them get worse results. Why? Because investors buy when emotions feel good and sell when emotions feel terrible. That emotional gap quietly destroys long-term wealth. Now let's put actual numbers behind that. Imagine two investors, same age, same index fund, same $500 monthly contribution, same 30-year investing timeline. One investor stays invested through crashes and averages 10% annually. The other panics during downturns, misses recoveries, and averages 6%. At the end of 30 years, the disciplined investor ends up with roughly $986,000. The emotional investor? About $502,000. That's nearly $500,000 lost to fear. Not bad investing, not low intelligence, fear, compounded. Now you might be thinking, yeah, but sometimes selling early makes sense. Isn't protecting yourself smart? Sure. Sometimes caution is rational. But here's what most people don't realize. The majority of investors who panic sell don't magically buy back at the perfect bottom. They wait, and wait, and wait some more. Because after you panic once, your brain starts needing emotional certainty before re-entering the market. And emotional certainty usually arrives after the recovery already happened. That's the trap. Some of the strongest market rebound days in history happened immediately after massive crashes. Meaning if you sold during peak fear, you probably missed the recovery too. And missing just a handful of the best market days over decades can absolutely destroy your long-term returns. This is why panic selling is so dangerous psychologically. It feels safe in the moment. But financially, it's often catastrophic. Now look, even professional investors struggle with this. Morningstar's Mind the Gap research showed that investors often underperform their own investments because of poor timing decisions. And yes, that includes professionals. People with finance degrees, people managing millions, people who appear calm on television. Veer does not care about credentials, because investing is less about intelligence than people think, and far more about behavior. Here's another psychological bias that wrecks investors: loss aversion. Behavioral economists found that losing money hurts roughly twice as much as gaining money feels good. That's huge. It means a portfolio dropping from $100,000 to $80,000 doesn't emotionally feel like a normal decline. It feels devastating. Your brain magnifies the pain, which explains why perfectly rational long-term plans suddenly collapse during volatility. Then you add herd behavior into the mix. Humans are social creatures. When uncertainty appears, we instinctively look at what everyone else is doing. So, when markets crash and everybody starts panicking online, your brain interprets that as confirmation of danger. If everyone's selling, maybe I should too. But here's the irony: the crowd usually reacts emotionally at exactly the wrong time. By the time panic hits the masses, most of the damage is already done. That's why experienced investors often move opposite the crowd emotionally. Not because they're fearless, but because they understand how fear spreads. Now let's talk about recency bias. This one's brutal. The human brain naturally assumes recent events will continue indefinitely. So if the market's been falling for 2 weeks straight, people start imagining endless collapse. They forget history. They forget recoveries. They forget that every crash in modern market history eventually rebounded. Because emotionally, recent pain feels permanent. This is why every market crash feels unique while you're inside it. Every single time. In 2008, people thought capitalism was ending. In 2020, people thought the global economy would collapse permanently. During inflation spikes, people thought markets would never recover. And yet, historically, recovery followed every major downturn, every single one. Now, let me give you a real example. Back during the COVID crash in 2020, I had a friend. We'll call him Aaron. Aaron had been investing consistently for years, mostly boring index funds, long-term mindset, pretty disciplined overall. Then the market crashed over 30%, and suddenly none of that discipline mattered emotionally. He called me panicking. "Hey, this thing's collapsing. I'm getting out until things calm down." I told him the same thing I'll tell you right now. Every crash feels permanent in the middle of it. He sold anyway, locked in losses, moved to cash, waited for certainty. 3 months later, the market had already exploded upward again. He missed one of the fastest recoveries in market history because emotionally he needed things to feel safe before re-entering. And by the time they felt safe, prices were dramatically higher. Now compare that to another friend, Mia. Same crash, same headlines, same fear, completely different reaction. Instead of selling, she increased her investments. Her mindset was simple: if quality assets are discounted, why would I stop buying? Fast forward a couple years, and her portfolio massively outperformed. That's the difference between emotional reaction and strategic thinking. Now look, I'm not saying crashes are fun. They're not. Watching years of gains disappear temporarily feels awful. Even experienced investors feel stressed during volatility. The difference is disciplined investors don't confuse discomfort with danger, and that distinction changes everything, because volatility is normal. In fact, volatility is the entire reason higher returns exist in the first place. People want stock market returns without stock market pain. That deal doesn't exist. The returns are the reward for tolerating uncertainty that most people psychologically cannot handle. That's why patience becomes such a massive financial advantage. Most people simply cannot stay calm long enough for compounding to fully work, and compounding is unbelievably powerful. This is where people underestimate time. Warren Buffett built the majority of his wealth after age 50, not because he suddenly became smarter, because compounding needed time to snowball. Time is the cheat code, but panic interrupts time. That's the real danger. Now you might be thinking, okay, but what if this time actually is different? Fair question. But here's my answer. If global markets never recover over the long run, your investment portfolio is probably the least of your concerns. Because that scenario means economies permanently collapsed, businesses stopped innovating, productivity died, and society itself fundamentally broke down. History says otherwise. Human beings adapt, businesses evolve, technology advances, economies recover. That's what they've consistently done for generations. Every bear market feels endless while you're inside it. Then, years later, people look back and realize it was temporary noise in a long-term upward trend. Now let's talk solutions. Because understanding psychology is useful, but only if it changes behavior. First, build an emergency fund. This is huge psychologically. If you don't have cash reserves, every market downturn feels personal because you might actually need that investment money to survive. But if you have 6 to 12 months of expenses saved, crashes become far less emotionally threatening. Liquidity creates calm. Second, automate your investing. Automation removes emotion from the process. Money gets invested whether markets are euphoric or terrifying. That consistency matters more than most people realize. Third, pre-commit your rules before volatility happens. Write them down. If the market drops 20%, I do nothing. If it drops 30%, I invest more. Because panic destroys decision-making quality. You need systems stronger than your emotions. Fourth, reduce noise. Seriously, stop doom-scrolling financial panic content during crashes. Financial media profits from your fear. The more emotional you become, the more engaged you stay. Constantly checking your portfolio is like reopening a wound every 5 minutes to see if it healed. It doesn't help. And fifth, redefine risk. Most people think volatility equals risk. It doesn't. Permanent loss is risk. Selling quality investments during temporary panic is often far riskier long-term than staying invested through volatility. Here's a metaphor. The market is like flying through turbulence. Passengers panic because the plane shakes, but experienced pilots know turbulence is normal. Uncomfortable? Absolutely. Dangerous? Usually not. The people freaking out mid-flight don't improve the outcome by panicking, and investors don't improve returns by emotionally reacting to every downturn either. Now here's the final thing I want you to remember. Most investors panic because they mistake emotional discomfort for actual danger. But wealth building requires emotional endurance. That's the game nobody talks about enough. Not stock picks, not fancy indicators, not predicting recessions, emotional control. Because over long periods of time, the market tends to reward people who remain disciplined while everybody else emotionally self-destructs. And once you truly understand that, crashes stop looking purely negative. They start looking like opportunities hidden inside fear. So the next time your portfolio turns red and your instincts scream at you to run, remember this. Fear is normal. Panic is human. But reacting emotionally is optional. The investors who build real wealth are usually the ones who stay rational while everyone else loses perspective. That's the edge, not genius, steadiness. And before you go, I want to ask you something. What's your biggest investing weakness? Fear, impatience, or overconfidence? Drop it in the comments. If this video helped you think differently about investing, hit that like button and share it with someone panic refreshing their portfolio right now. Because wealth isn't built by predicting every crash perfectly. It's built by staying invested long enough for time, discipline, and compounding to do what they've always done. Stay patient, stay disciplined, and I'll see you in the next one.